Record. All right, welcome to the Real Estate Hustlers podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Properties. Today we have my friend John Crowell. He is the founding partner of SaaSyREInvestors. John is an experienced commercial real estate deal maker with over 15 years of experience in both retail and multifamily assets. John has experience managing the full deal cycle process. It includes forging relationships with brokers, bankers, property managers, general contractors, accountants, and attorneys. In only 2 short years, John has rapidly grown his real estate portfolio to over 40 million in assets under management. Today, John will be talking to us about creative financing and deal structures. John, we're happy to have you here. Please tell us a little bit more about yourself.
Yeah, well, Josh, it's a pleasure to come on here today and hopefully share some value with your audience and with you, and just really looking forward to it. Really looking forward to this conversation. Yeah, so I think you summed up my background pretty well. So I don't know if I could beat that, but I think one thing I'll add is I was just like everyone else that's probably listening in today. I was a normal guy. I had a W-2. Working within technology and software, and real estate kind of found me in the sense of I was making good money, I had high active income, and I was starting to get exposed to very high tax bills, and I was seeking out ways to mitigate that. Now, I've always owned some sort of real estate, a couple retail pieces, etc., but not at the propensity that I own today, right? And so I wish I had some cliche answer to tell you, like I grinded through the trenches and found my way to real estate and this, that, and other, but like really real estate found me. And the main reason why it found me was because of the tax the potential tax mitigation that it offers with depreciation, right? Once you become an active real estate investor, you can use that depreciation to then offset all income streams within your household. And so that's why it helped just kind of identify itself as being a nice vehicle for me and my family, is just because of those tax benefits that real estate offers.
Perfect. Was there a catalyst that kind of propelled you into real estate, like a book or a friend, family member that kind of led you down the path?
Yeah, absolutely. I'm very blessed. I live in Charleston, South Carolina. It's a beautiful place. Hopefully many of you have been already, but it's also a multifamily hub of multifamily investors. There's a lot of major hitters that live down here in Charleston. And so, I was in some of those circles of those folks, and through that network, through those connections, what I started to realize through just conversations with friends and close acquaintances that, real estate, I always knew real estate was a great vehicle. It was, one of the key vehicles in most millionaires' balance sheets, right? That's how they've accumulated their wealth. But I didn't really understand the tax benefits and how fast the vehicle can be. And when I started to expose myself and having those conversations, I realized, like, hey, this could be something that could work for me, And so my friends kind of challenged me, like, hey, why don't you're really good with numbers? Why don't you do this, kind of thing. And so that's kind of how it all came together, is just through, friends and close acquaintances challenging me and saying, hey, I think you should probably consider doing this. And then just like everything that I do, I'm a very curious individual, and I just indulge myself into it. So I spent about almost a year just like really learning, really understanding it better before I actually bought my first property.
Perfect. Good deal. Yeah, it's definitely important to learn the game before you enter it. Like anything else, there's risks, and if you don't know the nuances, even how to underwrite the properties, unfortunately, the industry is unforgiving. So if you get into the wrong deal, you're stuck with it to the end. So education is certainly key. In this industry, why would you say creative financing and deal structuring? Why is it important in real estate?
Yeah, I think it's more important than ever, actually. It's probably not surprising, if you're not aware of the rising interest rate environment, you're probably living under a rock, right? Because of the rising interest rates and some of the macroeconomic factors that are happening right now, it's creating some issues between what sellers are wanting in terms of their, what they want to sell their properties for, versus what the buyers can actually pay, right? Because of
Yeah.
the increase in debt and inflation's a real deal. So like the expense ratios are increasing. And so there's a discrepancy between what the sellers want and what the buyers are willing to pay. Well, what I love about creative financing is it's another means to get the seller what it is that they want and to get the buyer what it is that they need, right? And so what I mean by that is if we can't come to terms on a conventional takedown price, right? Let's just use $1 million as an arbitrary number. Maybe the buyer wants to pay 800, the seller wants $1 million, right? One of the options that you could consider doing is saying, hey, well, look, obviously we're a little bit apart from each other here on this number, but what if, based on everything you told me, let's just say in an ideal scenario, they're not really in need of cash, or maybe they just need a certain piece of that cash to do whatever it is that they want to do. You already like the property obviously because you own it. What if you were able to, hold back a certain portion of that purchase price to where then we could pay you interest only payments for a period of time to help bridge that gap in between what I'm willing to pay and what you're willing to sell for. And surprisingly, at least the properties that I'm dialing in on, which is Class B multifamily in the Midwest, a lot of these are mom and pop owners. And so they don't really have a plan, if you will, with the proceeds. And so a lot of times the answers that I'm getting is like, yeah, I'm just going to put the money in my account for a little while, see what the market does, see what happens in the world. And I said, well, look, you obviously already like it, you own it. What if you were able to, kind of remove all responsibilities and liabilities of that asset, give you 80% up front, let's just say, or 70% up front, and we're able to work out some arrangement with the remaining balance, if you will. And I'm getting a lot of sellers that are raising their hands to that because they want to be able to increase their ROI. They don't want to take a much lower purchase price. They want to be able to maximize their return on their investment. And that's just an example of a way that you can do that.
So the mom and pop owners that you mentioned, these are the mom and pops that are managing the day-to-day activities on the properties, and they're just wanting out of being in the front seat, or is it another situation?
It varies, right? I would say most of the deals, I've done over $10 million in seller financing deals over the last 12 months. And, the seller profiles varied a little bit, but for the most part, a lot of these individuals were nearing, the latter stages of their life. They were entering into retirement, if you will, if you ever really retire, but they're wanting to slow down, right? Once you accumulate a certain amount of wealth, money's important. It's always going to be a driver, but it's not necessarily the main driver, right? Your peace of mind, your lifestyle, those things start to play into some of the decisions that you make. And for some of these sellers, they're at the stage where they've worked their tails off for 30, 40 years, and they're just tired. They're like, hey, I just don't want to have to think about this thing anymore. And so for me, I just want to be able to sell it, be done with it, and live the rest of my life doing whatever it is that they desire to do. Maybe it's golf, maybe it's travel, whatever, right? So I'm running into a lot of sellers that are in those latter stages of their life that are just looking to exit the asset because they're just exhausted. They've worked hard throughout their life and they're ready to really enjoy it. I don't care if someone tells you, hey, real estate's entirely passive, you don't have to worry. Well, for some people it is. If you're a passive investor, limited partner, just put money in a deal, whatever, there's still a emotional tax to it all to think about it. But as an operator, you're not entirely passive. There's still managing the PMs. It's still, having going through those reports. It's still a lot of work, right? Regardless if you have a team in place or not. So for a lot of these people, they're just tired. They're just ready to move on.
Got it. And you're able to offer them peace of mind plus cash flow every single month from the asset. That's huge.
Exactly.
Cool. So a couple other questions here. If you had to do it all over again, actually, let me back up 1 second because this is the biggest the biggest one here. So you went from 0 to $40 million of assets under management in 18 months, and you're owning over 50% equity across the portfolio. So John, that's huge. That's impressive, and we'd definitely like to hear how that journey took place.
Yeah, happy to lean into that a bit for your audience. So, again, I'm not a special type of individual here. I often say I'm definitely not the smartest guy in the room type guy. I just work hard. I put one foot in the front of the other, very persistent and consistent, very disciplined individual. So, yes, it's a great accomplishment, but if I can do it, anyone can do it. And I honestly believe that. And how I did it was I just I focused on one thing at a time, and I didn't try and, set a goal that was so lofty that I just was never going to be attained. Right. So the first goal was just to buy something. Like, it didn't matter really what it was. I just wanted to get my feet wet, because that's ultimately how you learn. Right. You can read books all day long, go to these conferences, you can join these masterminds. There's a lot of people that consume, not a lot of people that are doers. Right. So for me, I was like, all right, I spent 6 months consuming. And then I was like, let me take that consumption, the information that I would obtain, and actually do something with it. Right. So I was able to take down a 5-unit, was my first ever deal. It was a 5-unit, actually off-market deal. Did what everyone tells you to do, is just tell everyone what it is, what you're up to, which I did. I told my friends, like, hey, I'm going to be interested in buying an apartment building. Coincidentally, I told that to a really good friend of mine that I grew up with. He's like, hey, I got a client, because he's in the insurance business. I got a client I think wants to sell his building. I was like, really? Well, let's drive over there right now. So he drove me over there. We called the owner of it up, and we walked it, and basically right then and there, took the numbers, quick math, made him an offer, shook his hand, and the deal was, we came to an agreement. It was that simple.
Nice.
Took that deal down. Fast forward, I took down a triplex shortly thereafter, ended up taking down a 6-unit, an 8-unit. And that was the smallest properties that I had acquired. Within 3 or 4 months thereafter, was those smaller units. Everything from that point on has been above 25 units. And so, again, I kind of got my toes wet, or dipped my toes in the water to figure things out a little bit. And then I started to scale faster once I had a good grasp on things, and I felt comfortable doing so. Right. A lot of it was, a lot of the deals were on and off market. Every deal that I had taken down has been done in a slightly different variation too. I think that's another important call out, is I'm a very flexible person. So I don't just, it's good to have your investing principles for sure, but you have to be flexible too, right? Because at the end of the day, you have to figure out what the seller wants in order for you to get what you want. So I've been able to kind of mold my deals around what the seller wants, and then reverse engineer to make sure that I can get what I want. And that's a combination of conventional takedowns where I put my own money in, JV partnership deals where me and some buddies and friends put money in, and I've syndicated deals, right? I've syndicated some deals. And I've also just, I've done creative financing structures where it didn't even require any of my money. It didn't require anyone's money. I just structured the deal in a way to where I could get the seller to hold back a certain level of the purchase price, so that the bank would, so we meet the banking criteria of the LTV or the LTV loan to value criteria, so that it wouldn't actually have to bring anything to the closing table. So it's a real high level summary, but in essence, the summary of that is I was super flexible and willing to work around the seller's needs to be able to take down all those properties. So 0 to a little over 500 doors in less than 18 months. I got a portfolio under contract right now, which will add, it's 27 apartments, 25 storage units, 12 single family homes, and then a laundromat. And then I got a couple other deals, 77 unit deal I'm working on today that well, the initial actually didn't get the accepted offer. It actually went to another potential buyer. They actually fell out. And so they came right back to me and was like, hey, do you want to do this now? And so I was like, yes, I want to do this. So,
Nice.
So long story short, maybe a little over 600 here, hopefully by year's end. We'll see how it all shakes out.
So with today's market, the interest rates, of course, are out there. They're yelling at everybody. What are is that holding you back, or is it something that you don't see as being an issue?
Well, look, I think it's something you have to acknowledge, right? Like, rising interest rates increase debt costs. So you have to factor for it. It's probably another way to kind of frame it up here. So it's like anything else. Like, I try to remove my emotions from anything I invest in. It doesn't matter if it's stock, doesn't matter if it's real estate, it doesn't matter. Remove your emotions from it, right? What's the cost of debt? Make sure you're a good steward. So you factored for that. And then also, like, if you have a refi, if refining is part of your strategy and you're looking out 2 years, 3 years, or 5 years, you need to be as realistic with yourself as possible to paint doomsday and say, okay, well, if I go back and I need to refi in 3 years, refinance the debt to get, pay back investors or whatever you're doing, what do I honestly believe the interest rates to be, right? Do we see them going up? Do we see them going down? Like, what do we see? Be as conservative as you can in those assumptions. So when I'm looking and analyzing a property, all I'm doing is I'm increasing the debt cost. So when I'm doing my calculation, I'm factoring for that. So as long as the deal still pencils at the higher debt cost, I'm still buying the property, right? Because if the numbers still add up, it still blinks green to me. If you will, I got this little Excel formula that I use. If it blinks green to me, then I'm going to buy it, right? And so we take into consideration these rising interest rates into our equation, and then if the deal still passes the smell test, we purchase it. For
Are you
me
looking?
in my Oh, go ahead. Sorry.
Sorry. Are you looking for a bridge debt or a agency, conventional? What kind of debt do you go for when you're purchasing?
Yeah, so I have actually have no agency debt, which is another topic maybe for another day. But most of my debt is conventional through smaller banking institutions. So think like credit unions, smaller town banks. I'm playing in Indiana and Illinois. That's where my properties reside. My entire portfolio. These are smaller markets. They're rural markets, and so it's really difficult to get agency debt in those smaller tertiary markets. And so if you do, the terms typically aren't that great. Whereas if I go to a credit union, I can get 80% loan to value. I'm still getting, even up to today, under 6% rates. So still pretty attractive rates with everything that's going on. And in most cases, 25-year AM. So again, it's maybe not as enticing as agency debt, but the loan to values and stuff typically are a little bit better if I were to go the agency. So it's just it's a math equation to say, ultimately which one is better. The only downside to the debt that I'm taking on for the most part is it is recourse. So that is a variable you have to consider. There is a liability component to that you have to factor for sure. For me, the path that I'm choosing to go right now, at least this may change over time, and there's risk in everything. I don't care if you have non-recourse or recourse. There's always risk. And if you really know what you're purchasing, if you really know what you're doing, you got to factor for those risks. Typically, when you're buying non-recourse debt, there's going to be an increase in interest rate to purchase that non-recourse status. So at some point, do you start to self-insure, right? And those are the things that I'm really looking at right now with me and some of my business partners is, do we just start to build up cash reserves in a separate account and forget about it? And just use that as a self-insurance blanket, if you will, for if something were to go wrong, we pull out of that non-recourse or that, blanket fund, if you will, to help offset any, unexpected black swan events or things of that nature. But, business, if you're in business, you understand there's risk. If there's no risk, there's no reward. So for me, I don't get too concerned about it, but I also am very intimate with the properties that I'm purchasing, the markets that I'm buying in essence, the playbook that I'm playing, you know what I mean? So it's just something that you got to kind of evaluate on a personal basis to see if that's something you're comfortable with.
Yeah, that's perfect. And recourse is it's fully personally liable, and non-recourse. There's bad boy carve-outs, but it doesn't necessarily tag down your say debt to income on a recourse level. Okay.
Yeah,
cool.
there's definitely some advantages to the non-recourse from a balance sheet perspective, and when you're looking at your, like I said, the debt to income ratio and things of that nature. Yeah. Again, it's just you got to factor all that stuff in.
Yeah, absolutely. If you had to do it all over again, what would you do differently?
Yeah, so I'm gonna try not to sound cliche here, but I truly would have went, bigger, faster, or earlier is probably the best way to say it. So like, I tackled that first deal on my own. I have no investors, no partners. It was just by myself. It's a 5-unit. It produces almost 30 grand in net cash flow per year. It's a nice little asset, but I got lucky. I got real lucky. Like the properties, knock on wood, it's performed really well. And all the things have worked the way that I was hoping it to work. The reality is that isn't typically what happens, right? Typically when I talk to new investors, if they do something like that on their own, there's a lot of horror stories, things that just don't go as planned. They didn't factor numbers correctly. They're losing money. It's a time suck. I mean, there's just a lot of things that I hear often, and it's unfortunate. Now they're learning, which is a benefit for sure. But I think you can skip that a little bit by just, if I had to go back in time, what I would have done is really vetted out potential general partners that I wanted to partner with, right? Just really vetted them out and said, hey, look, here's the deal. I know your typical subscription or your typical buy-in is just the investor gives you money and then you send them a check, and then that's really how that relationship works. I'm going to give you the money, but the caveat is that I just want to be a fly on the wall. So I just want to be in the property management calls. I want to sit in the strategy calls. Like I want to learn during this process and have that kind of upfront contract with that general partner, and go that route. The reason for that, typically you'll often get better returns, believe it or not. In many cases, if you just invest passively, you're almost getting paid to learn, right? So instead of paying to learn, they're paying you to learn, right? So that would be my recommendation. If I were starting out again, I think I would have opted to do that versus the route that I had chose, just because of the risk and everything else. I think, I got lucky, but I know a lot of people don't get as lucky as that I am. So that would be my recommendation to myself, is like, hey, think of this more in the terms of decades versus years. So yeah, I may be losing a little bit more maybe up front if versus if I would have just taken it down by myself or get a smaller property, but how much am I going to gain in just insights and knowledge to then scale me into decades from that ability to be a close proximity of a very seasoned general partner. That would be that would be what I would tell myself if I had to go back again.
That's perfect. Well, I think that you helped hedge against luck by educating yourself first before just jumping into a rental project and hoping for the best. I mean, to me, that is where it truly gets risky, is where you've got someone who hears that real estate is this, real estate is that, and they just want to get in, but they don't educate themselves on how investing in real estate actually works, cap rates and IRRs, and just your basic your level of the numbers that you need to meet for the property to perform correctly. But awesome. So just doing it differently, you would get in with a general partnership group and learn from them on a high level, and that would be huge. Actually, I like that a lot. I would probably do the same on my end. Propel yourself forward a couple of years. What would you attribute to your success?
I would say not giving up. This is something that I see often is, I'll get people ping me all the time, like, hey, where do I start? And, it's the same question, like, what's the elevator to success, or what's the cheat code, if you will, right? The cheat code is you got to work your ass off. Sorry, I don't know if I'm cussing this show or not, but you got to work hard. I mean, that's the reality, right? And so real estate, you don't see a lot of reward, if you will, truly in real estate until you meet the decade mark. I mean, I made tons of money this year off of acquisition costs and front end money and all that, multiple six figures, right? Tons of money. But that's not generational wealth. That's not going to change. That's not only going to change my life. Where real estate's going to change my life is when I've been doing it for a decade, right? I'm on year 3. And so I got 7 years more to go, is what I keep telling myself, to where I can truly recognize the major benefits of owning real estate. It's all that debt pay down. It's that appreciation over long periods of time, to where, you start to really benefit truly from the level of acquisitions that I've done. And so I've just woken up every single day like I typically do, and I put in the work, no matter if I took down a deal or if I didn't. Right? I still just do the work day in and day out. And I say, so for me, it's just being disciplined to prioritize real estate as something that, is going to really take my family to the next level in terms of wealth. I typically get up at 3, I go to bed super early, but I get up at 3. I prioritize the first 3 days or 3 hours of my day is into my real estate activities, right? It's been that way for 3 years. Nice. So if I had to attribute one thing, it would just be work ethic of purely committing time to the initiative, to the desires to build this up. And that's what's led me to where I'm at today. It's the compounding of all that work.
Nice. How are you getting deals done today in the higher interest rate environment? Now, we touched on this a little bit before.
Yeah. So, again, I think it's just a matter of, you got to look at deals differently. You can't use the same formulas, the same expense ratios as you did before. You got to adjust for all those things. I'm having I think over the next 12 to 24 months, I'm going to build so much wealth. Like, it's going to be insane, because there's so many people that still want to exit or sell their properties, but they're not going to be able to sell it for what they originally thought. And so I'm going to be one of the few people that really understand how you can structure debt in an advantageous way, both for the seller and the buyer. So I'm taking that angle almost on every conversation I'm having with sellers is like, hey, well, look, I mean, here are the facts, right? So if you take this to market and based on the cap rate, based on your, the income approach, this is what it's worth. So you're gonna accept that offer, or you could accept my offer with some unique structures to it, but then you can yield this return, right? So it's helping them understand in a simple format of here's option A, here's option B. Option B looks way better if you really understand how all this works, right? Which that's my job to help them understand that. And so I just truly believe over the next couple years, because of the, approaching recession, some of the economic factors that we have going on, if you're really good at your craft and you know how to structure things, there's going to be a lot of opportunities to do that coming up. It's great for operators because, when I do creative structures, I don't bring in investors typically. My balance sheet's grown up enough to where I can sign on the loans. I don't need a sponsor. So I'm retaining 100% equity of the deal, not requiring any investor funds. I don't have to go through all the SEC stuff, right? Securities Exchange Commission. You eliminate a lot of the red tape and the kind of the hurdles, if you will, of getting deals done when you can also get that seller to potentially fund your down payment, if you will, which is really nice as an operator to be able to own 100% of an asset and not have to put a dime into it.
Yeah, that's a huge play. That's for sure. What are some important aspects to ensure a deal's success?
Asset management or the operations is the most critical piece of it all, right? So many people get so excited and I do too still, but when you put a deal under contract and you get it across the finish line, that's the easy part. The hard part is actually taking that asset and delivering upon your pro forma or your projected, numbers or budget, if you will, forecast, right? It's taking it from what you said you're going is for where it is today to where you said you're going to take it. That's really, really difficult. A lot more difficult than people think it is. You are dependent typically on third-party people, property managers, construction crews, other vendors, right? It's not just you at that point. You can't just will yourself through that. You're going to need, especially if you go to larger properties, you're going to need other people to help you do it. And so it can be very frustrating at times when people don't do what they said they're going to do, or things don't just line up, and oftentimes it doesn't, right? So focusing in on the operations and the asset management is the most critical part of owning real estate. It will make or break your investment, period, right? So getting a tight grasp around that is probably the most critical part of a deal, of a life cycle stage of a deal.
Yeah, once you take over a property, you get to see the effective income, the tenants who are paying versus the ones who aren't, the bad actors, and it is when you take a deep value add project, something that might be in let's say a D or a C minus area, and you're bringing it to a B, it can definitely weigh on you, but there's always light at the end of the tunnel if you're diligent, for sure.
That's right.
Awesome. Well, John, we truly appreciate you taking time out of your day to get with us on here on the show. I'll have your contact information in the recording as I send that out. But for now, how can people get a hold of you if they have any questions or just general inquiries?
Yeah, so one of the areas that I'm the founder of a operation called SaaSy, as you mentioned, SaaSy. SaaS stands for Software as a Service. So I founded a community that's connecting the dots between software professionals in real estate, both active and passive investors. So regardless of where you fall in that spectrum, you're welcome in the community. So if you go to SaaSyRealestateInvestors.com, you can you'll see a link there where you can jump in the community. You can interact directly with me via the platform sits on a Slack channel, which is often used by software and IT professionals. Is the channel that we use, but you can opt into there. You can direct message me anytime you want with questions and things that you need. That's typically the best way to engage with me. You'll be able to get faster responses. I'm also on LinkedIn, pretty active there. John Crowell, JOHN CROWELL. So you can follow me on LinkedIn or go to my website, get plugged into the community. A lot of great stuff there. Like I said, if you're considering to be active or passive, there's some deals and stuff that will come up in there that typically don't hit the mainstream public, if you will, that you'll be able to get first lens into if you want to participate in those. So a lot of good stuff in there. Definitely recommend your audience to check that out.
Nice. All right, John. Awesome. We appreciate your time, and you're rocking and rolling. But hopefully we'll have you on in the future too as your portfolio grows.
Absolutely, man. This is a pleasure. Thank you.
All right. Thanks, John. Bye.
Bye.